From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello and welcome to the COB on this windswept, rainy day in Sydney, at least. I'm Nadine Blaney.
I'm Juliette Sarli, and of course it is the first day of the new financial year.
Happy financial year.
New financial year. Exciting times, July. Let's have a look at where we have gone. Not very fast today, not anywhere very fast I should say. Pretty flat session, of course, records coming through on the S&P 500 and the NASDAQ indexes overnight, but a little bit of a flat momentum after a 10% gain over full year 25.
Yeah, we've got investors sort of pondering Trump's tax bill. So I guess that's the counterweight to some enthusiasm that's happening on the trade front. We've seen iron ore dipping on that Chinese factory data, which surprises me because it did actually move into expansionary territory, but also property woes continuing to weigh. And we've got the dollar struggling near 4-year lows. Again, a reflection of some of the concerns still remaining around tariffs and that big, beautiful act.
Yeah, indeed. All right, so that gets us to the themes of the day. We've mentioned happy new financial year and put top of the class in here today because one of the best performers on the ASX 200 is one of the worst performers from last financial year. So we know there's a little bit of a rebalance occurring as we kickstart the new financial year. It does look like there's been some insto buying as well in IDP education, which was hit by policy headwinds over the course of last year, down something like 130%.
Yeah, it's all the changing, not just the changing in policy here in Australia, but in the UK and Canada as well. It's interesting because it was a stock that we discussed on the call. And this was not today. This is, I think it was yesterday. Yeah, it must have been yesterday, given it's Tuesday. Anyhow, was there deep value in it? And then also people sort of thinking, okay, if you've got some tax loss selling going on, what then happens after that? And I guess we know.
We know indeed. All right. And then, of course, you mentioned the China data, the China Caixin manufacturing a PMI 50.4 coming up from 48.3 in May. So a little bit of a relief here as we start to see the truce, if you want to call it that, between the US and China. I had a great chat to Xiaopeng Zheng earlier from ANZ, talking about how he actually thinks China's sort of coming out a little bit on top here.
Yeah, interesting, because we still haven't seen that big stimulus, which we were discussing on the last call with our guests. And the expectations for that are quite low. And then I was chatting with my guests on the call today, just if we're going to start to see a rotation from the financials into the resource stocks. And they both said it was probably a little bit too early to be betting on that. And of course, that's excluding gold and uranium.
Oh, our guest is shaking his head in agreement. We'll get that shortly, but let's have a quick look at what we're seeing in terms of those tech stocks today. A little bit mixed there. How did the miners do with that iron ore momentum?
Yeah, we've got BHP off by 0.8%, Rio as well. Fortescue, though, bucking the trend there, as well as some of those more diversified miners. ANZ, that one stood out to me. I was going to look if we had any news going on with ANZ. I think maybe it could be just how much higher can CBA go, really? But then, we get burnt.
It did say it's retaining flexibility to adjust the pace of its remaining share buyback if needed. But I think it's probably because CBA, Westpac have been such outperformers over full year 25. CBA up 46%, I think, in the last 12 months. So just giving back a little today. But that's about $10 lower than where it was, I think, this time last week.
So there were two companies on those sector boards that were named by my guests on the call as buys for FY26. I'm not going to give it away. You will have to go and watch that program. It's up online, ausbiz.com.au. And you can also get the stock of the day on our YouTube channel. Yes, we do have one.
I think if they keep watching, they can get the stock of the day here as well.
They might be able to. I wonder how we're going to cover all those stocks of the day, which were all buys. So there you go. That'll keep you interested.
All right, IAG downgrading its full year 25 natural perils guidance by around 200 million, meaning that it's been able to lift its full year 25 profit guidance by the same amount. Shares down almost 1%.
Yeah, and Insignia Financial has confirmed that US private equity HMC Capital is still actively working towards making a binding bid. So that's a quote, and that has sent shares 5% higher to $3.83.
HMC Capital down almost 17%, deferring acquisition of its renewable energy assets by 1 month.
Downer selling down its 49% interest in the Keolis Downer joint venture for around $132 million.
And SGH, which of course has taken over Boral, there's news that Vic Bansal will step down as CEO there of Boral, but he also remain on the SGH board.
Yeah, shares are dipping in the wake of that. We saw some broker moves pushing Medibank higher. Mesoblast jumping on US FDA progress for its heart failure drug, and that new IPO doing well again today.
Yeah, Tetra Tech. I think because it's so new, we may not have the full gain, but it was up something like 8% today and was up 5% on its debut yesterday. And Orthocell rising on a strong June quarter revenue, upbeat US outlook.
Yeah, I think it was a record revenue result for Orthocell coming through, so in the smaller end of town. Let's make sense of it all, shall we? With our special guest today, Martin Crabb, who's joining us from Shaw Partners. So let's just pick up something we were discussing. You think it's too early to see that rotation from banks into resources? Because feels as if we've been saying since the beginning of 2025 that resources are going to come to the party.
Yeah, well, there was definitely the story of last financial year, wasn't it? If you were overweight financials and underweight resources, there was about a 35% differential between the two in a market that went up 10. So considering that both of those sectors make up about a quarter of the index, that's the trade you had to get right. The most clear winner on the financials is obviously Commonwealth Bank, and probably the clearest loser was probably BHP amongst the miners. So I think it comes down to a call on iron ore, because we talk about the resources sector, but if you actually look at the commodity mix, iron ore is by far the largest. So we can have a bullish view on copper, uranium, gold, zinc, lead, whatever else, but it's really steel making raw materials, so metallurgical coal and iron ore. And you look at China, like China's been producing excess amount of steel and exporting it, and the Americans have said no more, you're not going to do that anymore, so we're putting tariffs on steel. So that the Chinese are saying, well, okay, we either just shut down our blast furnaces or we continue to produce a lot of steel and sell it at a loss. Now, I don't think they're going to do the latter. So you imagine that steel production in China has peaked. They've stopped their big fixed asset construction cycle. They're now moving into more tertiary economies and high-end manufacturing, so they're not building as much stuff. So you kind of think that if China's reached peak steel, then that's peak iron ore and peak met coal, and that's peak earnings for those Australian companies. So they've had a pretty good run the past kind of 20 or 30 years, right? I think that comes to an end, and that rotation continues. So even though BHP, Rio, Fortescue look like they're quite attractively priced, 10 times earnings, good dividend yields, they've probably got negative earnings growth for the material future. As they diversify away from iron ore into copper and other things, it's just going to take a long time for that to happen. The flip side of that is financials. Can financials continue to expand their PE forever? My views on that.
Yes.
You do any sort of logical comparison of valuations to global banks or historical reference, and it just says avoid. It's just red lights everywhere. Doesn't mean the red lights can grow brighter. We've seen bubbles get really out of control in the past. But you've got to have some common sense here and say, I'm not going to just continue to pay more and more and more for the same amount of earnings when there's other better companies in the market I can buy.
So is the switch going to happen similar to what you were discussing there, but also with the tax loss harvesting and some of those companies that were dumped might be picked up now? Yeah,
well, you saw that today with IDP Education. I mean, probably one of the worst performers last year, down 70-odd%. Certainly amongst the big caps, we obviously had Mineral Resources and a few other things that, that's got a truckload of debt. IDP doesn't have a truckload of debt, it's just had an earnings hole. Down 70%, up 8 or 9 today, I think, and obviously still very, very shorted. So at some point those shorts go, I think we've probably made as much on this as we can. The next leg maybe not down, it's up. So I think Cetai is another one. Star, if you're really brave, really brave. But people may have sold this and want to sold it for the tax loss, but want to hold it. So in the next weeks or months ahead, they might go back into it. So where's the marginal seller going to come from these things? So some of these really, but Forex is another one. OFX, that's a really tough year. Again, if people have sold that in June to realise some losses, maybe they rebalance their portfolio and add that back. So I think you will get some performance. This is a really strong historical pattern. So I just this afternoon had a look at the All Ordinaries since 1970 and just looked at June versus July. Now the average month, the price index goes up by about 0.6. So that's about 7 and a bit % a year in price terms. You've got dividends on top of that. In June, it's down 0.5%. So it's 1% lower than average in June, and it's about 1% higher than average in July. So this tax effect, and the only thing you can put it down to is the tax effect. We get a similar thing in the US market, but in December and January. Their Decembers are really weak, their Januaries are really strong. So there's about a 2% difference. When you think about, I'm only making 7% a year, I can make an extra 2 just by selling in May, going away, and then coming back on the 1st of July.
I just note when we're talking about last financial year, healthcare was one of the worst performing sectors, down by about 6%.
Yeah.
It's interesting because that's traditionally a defensive sector. We were all talking defense, through late 2024 into 2025. So what's happening, and when will the worm turn?
It's been terrible, and most of that CSL, right? So CSL is the big dog in the kennel. It makes up probably 70% of the healthcare index in Australia, and it's gone from 300 to 200 in roundabout terms. So that's been a big underperformer. I think more recently, it's also the Trump administration's aiming at the healthcare industry, aiming at pharmaceuticals, aimed at most favoured nation status. And a lot of our healthcare index is a US story. CSL, Telix Pharmaceuticals, ResMed, Cochlear. The US is the biggest market for them, particularly in pharmaceuticals, because the US, due to their healthcare system, tends to pay the highest prices for drugs, something that the Trump administration wants to tackle. They don't see why they should be paying more for their pharmaceuticals than other countries are. So I think Australia's caught a little bit in the crosshair just by the nature of our index. It is made up of a couple of very large US-based healthcare stocks, but it's also globally, Nadine. I think healthcare globally has been a pretty tough sector. It's just been much worse here. And the two C's, CBA and CSL, have almost gone in opposite directions. They're almost mirror images of each other.
In terms of some of the companies that did very, very well, did they continue with the rate cutting cycle? I'm thinking of like the furniture retailer Temple & Webster.
Yeah, well, that's been a cracker, hasn't it? It's up 150%. There's some stocks last year which did really, really well, but they're more sort of growth stocks. I think Life 360, Sigma Pharmaceuticals has obviously gone from being a wholesaler to owning Chemist Warehouse. So there's been some stocks that have done really, really well. But I do think interest rate sensitive stocks make a lot of sense right now. I mean, the cash futures are pointing to 4 rate cuts. Most economists are saying 2 or 3, but if we get 4 rate cuts, we've got 2.85% cash. The Australian economy is in pretty rude health anyway. Wages are going up at 4. Everyone's got a job. Tax cuts are coming through. The government deficit's being reduced. Government spending's going up at 9% a year. Credit growth's picked up. So the Aussie economy looks really good. So I think domestic interest rate sensitive stocks make a lot of sense. When we made some changes to our portfolio back in April and May, we added more of those names, and not necessarily because they've got fantastic growth outlooks. They're just really solid. So the Telstras, the Dexus, the Metcash, these sorts of domestically focused stocks that are interest rate sensitive, they look quite attractive, and they're not trading, maybe with the exception of Telstra, not trading on very rich multiples. So I think that's a good place to put your cash.
So are you talking about Australian exceptionalism?
I am, yeah.
And so you think that extends out to potentially the ASX this year?
Yeah, I mean, the composition of the ASX is a little bit tricky because you've got, as I said, 25% banks which look expensive and 25% miners which look like they're facing falling earnings. But I think if you go out of that, I think it really is a stock pickers market. At a macro level, the Aussie market on 19 times with 4% growth does not look attractive. So you really got to go looking for these things. So I just think that if you focus on companies that are domestically focused with interest rate sensitivity and they're not trading on nosebleed PEs, if you can find some of those stocks, they're definitely worth adding to portfolios. So whereas the situation offshore, the tariff story is not over. We're going to hit the 7th of July, which is the 90 days, and God knows what's going to happen after that. Whereas I think Australia is relatively insulated. Like if you're buying, European auto stocks because they look cheap, or Japanese manufacturing stocks if they look cheap or whatever, they can get really caught up in a tariff war. Whereas Dexus with Office Trust, or Telstra with telcos, or Metcash with hardware and supermarkets, tariffs don't really impact those guys too much. So I think it's a little bit of a safe haven, but it's also saying the domestic economy looks pretty good.
Mm-hmm. Would you want to go out on a limb and say what sector or stock you think is going to be a full year 26 outperformer?
I only do that at Christmas time.
Okay.
I've got to wait for
Christmas in July.
I've got to wait for your show every year to do my stock of the year.
6 months to wait. All right, Martin, thank you as always. And for braving the weather. It's an awful day in Sydney.
Kudos
Martin
to
Crabb
him.
from Shaw & Partners.
Yeah, but to Martin's point, we've got Trump complaining about US-Japan trade talks and Bessent warning about higher tariffs coming through for Japan. So, yeah, I think we've taken our eye off the ball to some degree, to some extent, when it comes to the tariff situation. But 9th of July is looming. I just can't get used to saying July. So it's the 1st of July. It's actually Canada Day today.
Oh, Canada Day.
Yeah, happy Canada Day to any Canadians. Probably not, but he may be out there.
Maple syrup for dinner? Or?
No,
Okay.
we eat other things. Stock of the day, shall we? It was, top picks for FY26. Philip Pepe from Shaw & Partners and Rudy Philippek Van Dyke from FN Arena.
Okay, because I think analysts are just too pessimistic on the banking sector. My view, if you look at the historical data, interest rate reductions, sustained interest rate reductions, tend to result in high credit growth, and we saw a good print yesterday from APRA in terms of credit growth for May, and that tends to drive up bank share prices, just because volumes are growing. That's easier to increase your profits, and it tends to push share prices up.
Last year, 2024, investors might have got a little bit too excited about AI. I think AI is here to stay. Come January, February, all of a sudden AI had to be sold down. So all the share prices today are lower than where they were. And I think there's still, if you believe that AI is something that will define the next decade, not just the next year, then a lot of those stocks today are absolutely worth considering. Now, I personally own NextDC, Goodman Group, Macquarie Technology, and Dikke Data.
All right, let's have a look at the leaders on the first day of the new financial year. And we touched on Mesoblast's update, sending shares up by 10.2%. IDP, of course, the switch out, one of the worst performing stocks of last year.
Yeah, Clarity Pharmaceuticals was also one of the worst performing stocks of last year. So yeah,
as was Domino's.
Yeah, so some tax loss selling, morphing into some buying today. And Insignia on that private equity offer that looks like it might still come to fruition.
All right, the laggards today, HMC Capital, we've discussed why, down 17%. Lovisa, the jeweller, off by 5%. Still a bit of weakness in some uranium players. Boss Energy down about 4%, and Imdex and Gen Development there too.
Yeah, so keeping an eye on those stocks. Let's get to some of the small to mid-cap listed companies. And we've got Paradigm Biopharmaceuticals. I dare say they were out with an announcement today, up by 23%. And Silk Logistics up by 12% to $1.69.
And some of the laggards today, Vinyl down 8.3%, the dentist companies Pacific Smiles as well, and Metal Powder Works down by 15%.
Yeah, I was interested. I used to be a NAB member, don't mind sharing, and I was surprised when I went to one of their dental, it was actually operated by Pacific Smiles. I didn't realize that they did that. You learn something new every day. Anywho. I don't know why anybody would care about that story, but
we have lovely teeth, so maybe they're wondering where she gets her teeth cleaned.
All right, well, tonight we've got a man who you do want to listen to speak. It is the Fed Chair Jerome Powell at a monetary policy panel in Portugal.
Lucky him, Portugal in summer. All right, the US ISM Manufacturing Index tipped to inch up from 48.5 to 48.8, so still below that level between expansion and contraction.
And this is a very key read, the JOLT job openings data. So vacancies could fall to 7.1 million. So that's, we look at the quit right there to give us some indication of the health of the US jobs market. And of course, we're leading into the non-farm payroll report that comes on Friday.
All right, tomorrow it is Wednesday here. Building approvals for May, council permits, they're expected to rebound somewhat. Also getting retail trade figures for May, and ex-dividend, we're getting GrainCorp.
Yeah, okay, so we will keep our eye out for all of those data points for you tomorrow. Today, though, safe to say, Real flat session by the end of it. The S&P ASX 200 pretty much pancake flat at 8,541. I will note that we've seen US futures take a turn. S&P 500 and NASDAQ E-minis are currently lower. So yeah, just take that into consideration.
All right, that does it for the COB for this Tuesday. Thanks for your company. We'll be back from 9:45 a.m. Eastern tomorrow.